everyone. Welcome to Zoom at 8. My name is Julianne Peterson, and I'm your host tonight for Zoom at 8. I am a senior director at Old Capital Lending. So what does that mean? I am a loan officer, okay? So I can get you a loan for bridge, bank, agency, CMBS, okay? I start at $500,000 loan amount. It's not very much. So if you are doing a deal or you're looking to do a deal, I'd love to have the opportunity to take a look at it. We're going to need your rent roll, your T12, an OM, which is your offering memorandum. I want to see your underwriting, and I would really like to know what kind of business plan you have for this property. And then I can see what works best. You know, in an environment of like a commodity sale, which, you know, a lot of people look at brokers as a commodity, you kind of have to look at the value that we are creating. And so from Old Capital, we have the Old Capital podcast. We have our conference that we do every year. We have Zoom at 8. We have a speaker series that's coming up in May. It's usually a monthly meeting. So there's lots of opportunities to get to know Old Capital and what we do. And we are not considered a commodity broker. So we're hoping that we can create value for you and your friends and whoever else you're doing business with. So it has been crazy busy. You know, the lending environment has completely changed. I mean, we're over 5% on a lot of these agency loans. We're looking at 65% loan to value. I mean, it is crazy. So there's things that we can do to help you understand what kind of lending works for your property or the opportunity that you have, but not every deal is equal. Whether you have a sponsor or you don't have a sponsor, what your experience is, what your net worth is, all of that takes into consideration when we go to quote. So just kind of making sure you understand how we get the deal. I'll need those items from you. All right. Well, we've been doing Zoom at 8 for 3 years. It has been amazing. We've closed 11 deals now. All right. I am so excited tonight, as I told you. I think, Moses, you were the one that said, hey, can we talk about cost segregation? I think it was you, Moses. So I searched my Rolodex. For those of you who are under 40, a Rolodex, you go and you put your contact information. I went through my Rolodex and I found Brandon Hall, and I've been really impressed with Brandon. He's quite has quite a bit of experience in being a CPA, but on the internet, I've seen him talk and speak, and he has some very compelling information to share. And so I reached out to him, and so Brandon is a CPA. He's a national speaker and the founder, managing partner of the Real Estate CPA. Brandon works with real estate investors, syndicates, and private equity funds to optimize tax positions and streamline accounting and business functions. He believes that real estate investing is critical to building sustainable and generational wealth. Brandon's worked with PricewaterhouseCoopers and Ernst & Young prior to launching his own CPA firm, Hall CPA PLLC, and the Real Estate CPA. So through the knowledge gained by working with real estate investors, Brandon has built a real estate portfolio of multifamily, single family, and short-term rentals. So I am pleased to announce that Brandon Hall is here with us tonight. Brandon, welcome to Zoom at 8. How are you doing?
I'm doing well. Thanks for having me. It was a good introduction.
Oh, good. Well, you know, we're in the tax season, and many of us have already done our taxes, or some of us are waiting for our K-1s from our syndicators. And sometimes these syndicators get delayed. And so I am so glad you're here to talk to us about what is on our minds with cost segregation and what is also on our minds, which is the real estate professional status, what we can take advantage of, what we can't take advantage of. Is there anybody else who wants to talk about something tax associated with syndication and investing? Let's get it on the board. Anything that we want to cover tonight other than those two items?
Hey, Julie, if I may quickly, I just want to know, I had asked you to go find the real estate CPA guy, because just tell Anderson Cooper they don't cut it. He does. He can send me, Brandon, you can send me the check later, but he really knows Section 469, because I've been a real estate professional for years and no one could have explained it the way he does. So I think the group is going to have a treat tonight from Brandon.
I appreciate
You're a
that.
rock star. Well, see, there you go.
Now
There's
I'm
one of
nervous.
your. Well, this is great. So thank you, Moses. Anybody else have something that we want to get covered? Tonight's the night to ask. Cameron, you have a question? No?
Nope.
Okay. So Cameron is getting ready for a 1031 exchange. So if there's any questions on 1031 exchanges going into a syndication, there is this thing where you can go from like kind. If you're not familiar with the 1031 rules, you go with like kind from one asset to the next deal, right? The question is, many times people say to me, oh, don't tick into something. That's dumb. It's expensive. I can't find a syndicator that wants my tick. It's too expensive. Just pay the taxes, and then the cost segregation will cancel that out, and we're all going to live happily ever after. So I know I want to talk about the 1031 cost segregation and the real estate professional. Anybody else before we get started? All right, perfect. Brandon, you are ready to roll. Can you tell us, let's start out with cost segregation. You
Sure.
know, we hear, oh yes, I'm going to roll out 100% cost segregation, depreciation, and you've got syndicators going out there and telling everybody it's 100%. And I get a little bit nervous about saying that. So I want you to set it straight. What can we tell our people about how much is going to affect them when they're a limited partner?
Sure. So before I launch into it, we're going to do a quick chat poll. If you are a landlord, don't wait till I'm done before you type something in. If you're a landlord only, you type 1 into the chat. If you have your own rental, so you're a landlord and an LP investor, or an LP investor, so landlord plus or LP investor, type 2. If you flip, develop homes, wholesale, anything like that, type 3. And if you're just getting started, don't have anything yet, type 4. So 1 for landlords, 2 is landlords plus LP or LP, 3 is flipping, developing, 4 is just getting started.
Man, oh man, I should have set up a poll so we could get everybody to pull it, but
okay.
Good.
Lots of twos. All right, yeah. Cool. Lots of 1s too. Sweet. 1, 2, and 3. Like it. All right. So to answer your question, when you are, so we work at my firm. I've got 33 or 34 people now. We're hiring 1 to 2 people a month. It's awesome. Very cool. But we have 700 to 800 clients at this point, and we work with a lot of syndicators and fund managers. Our largest fund is a $1 billion fund. We are their CFO. We manage everything for them, all their books and records, all the investor reporting, everything. And we do it all remotely, which is even cooler. So what I can do, the cool thing about my position here is that I can talk about the GP side, but I can also talk about the LP side, right? So I get to give all the LPs here a little bit of a look behind the curtain, so to speak. But then I can also kind of talk some truth as to what you can actually do when you receive that K1, or what that actually means when you receive that huge tax loss on your K1. So first, to start with Julie's question. So Julie's question was, and I'm gonna paraphrase, but I'm a syndicator, and I've got this deal that I'm shopping around and I'm trying to solicit investment for. what should I be telling limited partners in terms of the potential tax benefits? Right now, through 2022, we have 100% bonus depreciation. I know that we've got a cost seg mark in the house, so you can gut check me on any of the numbers that I'm going to throw out here. But the numbers that I have seen from cost segregation studies from a bunch of different companies in general, you can deduct 25 to 30% of the purchase price. And I know that's not exactly how it works, Mark, but the numbers kind of tend to work out that way. 25 to 30% of the purchase price ends up being deducted via 100% bonus depreciation, because that cost seg study is looking at the purchase price less land, and it's taking that net value and it's allocating that value to 5, 7, 15, and 27 and a half year property. But the way that those allocations typically work is it's allocating enough to the 5, 7, and 15 year property to constitute 25 to 30% of the total purchase price. And any asset with a useful life of less than 20 years, we can immediately write off with 100% bonus depreciation. So for any cost seg or any syndication, that if I'm the GP, if I'm sponsoring a syndication today, I'm going to be able to tell my limited partners that we're going to do a cost segregation study. I'm buying this $10 million asset. We're going to do a cost segregation study. We're going to get $2.5 million of bonus depreciation. And then that's hopefully it. Hopefully I'm not going to give my LPs more tax advice or try to like start talking about their actual tax position. But that's all LPs really need to try to figure out how much. Well, there's one more thing that you need, but that's kind of half the battle to figure out what does it mean when I invest $100,000, right? So as a GP, I'm just going to try to give you some rough estimates. I think that we're going to get $2.5 million of bonus depreciation. I gave you this pro forma. The pro forma might show that I've got, I don't know, 2.7. Well, we'll get to the pro forma later, but the pro forma is going to show my net income projected for the year. And then I can also talk about how much capital I think I'm going to raise. Okay. So as an LP, you need those three things. You need to understand how much capital the GP is going to raise, what that bonus depreciation is going to look like, and what the net operating income is projected to be for the year. And I'll tell you why that's important in a second. But to answer Julie's question specifically, if I'm a GP, I'm just going to give you that information. And then I'm going to say, go talk to your CPA to figure out if you can use the passive activity loss rules or not, or how this impacts your personal situation. Now, the problem is when you give this information to your CPA, a lot of CPAs have no idea what to do with it, right? So they'll just say, cool, we'll get the K1 in April, we'll be good. But that doesn't really help you from a planning perspective, right? From a planning perspective, you would like to know today, if I invest $100,000 into this syndication, am I going to get a $90,000 tax loss? Am I going to get a $40,000 tax loss? Because I have another rental property over here that I would like to sell at a gain, a large gain, and I need to know if I need to do a 1031 exchange or not, right? Because the cool thing about the passive activity loss rules is that I can sell one rental at a gain and the passive losses from another activity can offset that, right? So it's important for me to understand whenever I'm going to make any sort of investment into a syndication that I know how much money is going to come back to me. So here's how you figure it out. Let's say that I have let's say the syndication is buying a $10 million asset. And you have this conversation that I was just kind of going over with the GP. So you go to the GP, you say, what's the bonus depreciation going to look like? And they say, we're going to get, I don't know, $3 million of bonus depreciation. So let's just say $3 million of bonus depreciation. What's the net operating income going to look like? The net operating income is projected to be $300,000. So now you know net operating income minus depreciation is a negative $2.7 million. So now we're talking about a $2.7 million tax loss in the first year on this asset. So then the next question is, how much capital are you raising? And the GP says, we're going to raise $3 million. Cool. So if you're going to raise $3 million and you're going to get a $2.7 million tax loss, most likely, and I say most likely with a caveat, but most likely the operating agreement that GP has is going to say, we are going to allocate tax losses to our limited partners, our investors, until their capital accounts reach $0. Most likely. Sometimes it'll say some other things, especially if you get into these smaller syndicates. It might just say we're going to allocate everything 50-50 or 70-30 or something like that. But most of the sophisticated, bigger syndications are going to say we're going to allocate tax losses to our limited partners first until their aggregate capital accounts reach $0. Well, what was the aggregate capital account? That's how much we were raising, right? $3 million. That's our aggregate capital account. If the tax loss was $2.7 million, then that means we're going to allocate 100% of the tax loss to our limited partners because we haven't reached $3 million yet of tax losses. So we're going to allocate the entire 2.7 million to our limited partners. And so what this tells you is that's a 90% loss ratio, right? So if I put $100,000 into the deal, I can expect a $90,000 tax loss passed back to me on my K1. Now, it might be a little bit different, might end up being 81 or 88 or 97. But if you get 30 passed back to you, that's when you know you have a problem. Somebody did something wrong. Either the operating agreement is wrong, the operating agreement could have been read and interpreted wrong by the person preparing the tax return. And that's when you get to start asking questions. So it's really like a relatively simple exercise to try to figure out. And I know I just threw out like a bunch of steps, but it's a relatively simple once it kind of clicks. It's just a few questions, right? What's the projected net operating income? What's the projected bonus depreciation deduction? How much capital are you raising? And once I get all that information, now I need to go hopefully look at that operating agreement or have somebody like a CPA like me come help you read that operating agreement and try to figure out how are we allocating losses. Once you get that information, you're going to be able to figure out really quickly, high level, I put $100,000 in, how much should I be expecting back? And now that can help move other decisions forward across your portfolio in other areas. Or if you've got a syndication liquidating that's $120,000 gain, maybe you decide in this next syndication, instead of putting 100 in, you're going to put 150 in, because then you're going to get a $130,000, $135,000 tax loss passed back to you. It's going to completely wipe out the gain from the syndication on the other side of the spectrum, right? So long
Can you
answer to
slow
your
that
question.
down? Because that is, I see Cameron kind of, I'm a little lost just because this is not what I do on a daily basis. So where I got lost is the 100,000 and the 90,000 passed back. Can you unpack that a little bit?
Yeah. So the way that we figured that out is we asked the syndicator, we asked the GP, how much capital are you raising? They said $3 million.
Gotcha.
What's the bonus depreciation? It's going to be another $3 million, right? And then what's the net operating income? $300K. So we do net operating income $300K minus the $3 million of depreciation. So we've got a $2.7 million tax loss.
Got that.
So 2.7. What you do at that point is you go to the operating agreement.
Got
and you
that.
go to the profit and loss allocation section of the operating agreement. Most of these operating agreements are going to say, first, we're going to allocate losses to our limited partners
Right.
until their capital accounts reach $0. And then we're going to do, different things. Then we're going to go through our waterfall and all that stuff. But first, we're going to give the limited partners their tax loss. And if I'm a limited partner, I want that in my operating agreement, right? I'm the one that's putting up all the capital. I don't want the GP to have anything if they didn't put any capital up. They don't get tax losses. I get I'm selfish when I invest in deals. So I get the tax losses, right?
Gotcha.
Until my capital account reaches $0. Then you can do whatever you want. So what happens is if we have a $2.7 million tax loss and we've raised from all of our limited partners $3 million, then our aggregate capital account is $3 million. So if we only have a $2.7 million loss, then the entire 2.7 million goes to our limited partners. If we had a $3.1 million tax loss, then the first 3 million would go to our limited partners, meaning at that point, if I put 100K in, I get 100K back as a tax loss because they've completely wiped us out. But then I've got this remaining $100,000 that then could get split up in a bunch of different ways, like this remaining tax loss. So the point is all we're trying to do is figure out a ratio of tax loss to total capital raised. And then I basically take that ratio and I apply it to my own investment to figure out what my tax loss is going to be. that make sense? Is that helpful?
Much, yeah, yep.
Okay. And then when you get to that point, then you get to go have your conversation with your CPA. And then you get to learn about the passive activity loss rules. And those rules dictate whether or not you can actually claim that tax loss. So that's why I want our GPs, I tell them, don't give tax advice. You can point them to our website. We have a lot of content on the passive activity loss rules, as Moses pointed out. Thank you, Moses. But I would not be, as a GP, trying to give tax advice. The GPs should always, always, always do the cost seg study, get the tax loss. Even if sometimes we get these syndications, we get a bunch of LPs like, oh, I can't claim the tax loss because the losses are limited. And I can't believe that they did the cost seg study. But what they don't know is that there's another LP, way down the line that was actually able to claim the losses. Right. And so that LP is good. They're set. So what we do is we say, GPs, you do the cost seg study, you get the tax losses. Some of your LPs will be able to claim the tax losses. Some of them will not. It just depends on their individual application of Section 469, which is the passive activity loss rules. So you can claim those losses that are coming back to you are passive by default. And those losses can offset other rental real estate income or gain on sale from a rental activity. So if I sell a rental property for a gain, tax losses from a syndication can offset it. A lot of CPAs will say, no, they can't. And I just say, ask your CPA to go prepare Form 8582. They'll be real shocked when everything nets out. And that's, you don't have to go into the code to confirm it at that point. You could go into the code to confirm it, but you don't have to.
Okay, before you go on, would it be advisable as a general partner to provide to your limited partners the capital raise, the bonus projected, and the operating income?
I think if they know what
Projected.
to do with that information, yes.
Okay.
But like most of the time, you'll have like a small cohort of people, generally the people that listen to our content, that will ask the questions, and then nobody else like asks. So I think if you provide that information to people, they'll just be confused and they'll be asking even more questions. What you could potentially do is like actually just do a webinar. Some of our clients have been doing that recently with us, and that seems to be going over well, because then you provide that information, but you've got a CPA that's like explaining the why behind it and helps people really understand what they're actually looking at.
Perfect.
Yeah.
Thank you.
No problem. Yeah. So you get this K1, right? And it's a negative $90,000 loss, box 2 of your K1. And in lower left-hand corner, you see your 100K investment minus 90,000. Now you've got 10K left. So the question is, what do I do with this $90,000 loss? Well, like I just said, the loss is by default going to be passive. It's passive because you're not materially participating in the activity. You're just a limited partner. You haven't made any management decisions. You haven't put any time into the deal. Even if you have put time into the deal, you cannot materially participate as a limited partner anyway. So you have to be on the GP side to materially participate. And I'll explain what that means in a minute. But the point is that because you have not materially participated, it's a passive loss. And that passive loss is subject to Section 469, which is the passive activity loss rules. These rules were implemented in 1986. So prior to 1986, I could go and put 100K into a syndication, get a $90,000 loss passed back to me, and immediately offset my CPA firm business income. No issues, right? So what did people do that earned a lot of money? They just went and bought a ton of real estate, and they depreciated it, and they mitigated their income, reduced it to zero, wrote it all off. So 1986 comes around, Congress decides that's not fair. All these rich people are using real estate as tax shelter. So we're going to implement the passive activity loss rules, which basically says losses from rental real estate are passive. Passive losses can only offset passive income, and excess passive losses are suspended and carried forward. So if I have a $90,000 tax loss from this syndication and I have no other rental activities, then that $90,000 tax loss is passive. There's no passive income because I don't have any other rental activities. And because of that, that $90,000 is suspended and it's carried forward. I cannot use it today. And that's where LPs get upset, because they go, well, I've got this big $90,000 tax loss now sitting on my books. That's not good. Nobody told me about that. Yeah. And then they come back and they ask the CPA and you, the GP, a bunch of questions about it. But it's not all bad news, because that $90,000 tax loss sits there forever until you can use it. And you can use it to offset future passive income or gain on sale from a future passive activity. So if this syndication liquidates, and let's say you get a $150K payout, well, you've got a $90,000 tax loss that's still sitting on your books that can offset that $150K payout. So you don't have to pay taxes on the full $150K. Or, like I said, another rental that you have sells. Let's say it's a $100,000 gain that you've got sitting on one rental, right? And so you're like, you go, I should probably do a 1031 exchange on this $100,000 gain. Otherwise, I'm going to pay $20,000 in taxes. But what you forgot is you've got this $90,000 suspended loss sitting on your books. You don't have to do a 1031 exchange. You could if you wanted to, but our firm would say, no, use the suspended losses, offset that gain, and get the tax savings today. So you have a net 10K gain that you would be paying taxes on in that example. So the suspended passive losses aren't all bad news, but it's important to understand when I get this K1, this big tax loss, I'm probably not going to be able to use it to offset my W-2 income, my business income, or anything like that. So what our clients do is they go in one of two directions. They go in the direction of, I'm going to use one of the exceptions to the passive activity loss rules. There are 3 of them. Or they say, I'm going to optimize my portfolio for the passive activity loss rules. And I understand that it's going to take 10 years to do. But that's kind of like that rich dad, poor dad scenario, where you just build out all these little income streams. And in the aggregate, it becomes really large. But the beautiful thing about the passive activity loss rules is that as you build these income streams out, they can all offset each other. And you can quite legitimately not pay tax. We have 2 clients that I know of recently. One that netted $300K, paid $0 in taxes this year. Another that netted, I think it was like $425 last year and paid like $10K in taxes. I mean, that's like the equivalent of earning a $700,000 W-2 wage, right? But that's cash flow. That's not like it wasn't their W-2 job. It was just cash flow from their rentals, and that's expected to continue for years. And just like the tax savings that come out of that, what are you doing? You're reinvesting those tax savings, right? You're just creating the snowball effect. You take the tax savings, you put it right back into a new property. So that's that optimization piece. And all you have to do to optimize with the passive activity loss rules, it does take time. But what you do is you keep buying assets. You keep buying assets, and eventually your assets will start to cash flow. Your older assets, as your depreciation is claimed on them and gets extinguished, especially if you're doing bonus depreciation from a cost segregation study, at some point those assets will start cash flowing. But you can keep buying new assets to create that depreciation advantage, create those tax losses, and mitigate those taxes. So that's one option. The other option, like I said, is to use one of the exceptions to the passive activity loss rules. So even though the rules were implemented in 1986 and the whole thing was, we're not going to let rich people invest in real estate and use the losses to offset their W-2 and business income, they do have exceptions to the rules. So the first exception is if you sell one of your properties, you can use losses to offset the gain on sale. So if I've got a bunch of suspended passive losses, I can use the losses to offset the gain on sale from one of my rentals. It's actually probably twice a year, we'll get a new client that is in the middle of a 1031 exchange when they onboard with us, meaning they've already locked their money up with the intermediary. We review the tax return and we go, oh, you have $300,000 of suspended losses. You're looking at 120 gain on this rental. Did you sell another property last year that used up all these losses that just hasn't been reported on this year's tax returns yet? And the answer is no, I didn't realize I had these suspended passive losses. So the first exception to the rule again is if I sell a rental, I can use losses from my other rentals to offset the gain on sale, or I can use suspended passive losses from other activities to offset the gain on sale from this rental activity. So keep that in mind. And if you want to know how to track these suspended losses every single year, all you have to do is look at Form 8582. It's in your tax returns. Everybody should have it if you've got rental activities, especially if they're passive. Form 8582. Prior years, prior to 2021, you were looking at line 4 on that form. But going forward, I believe it's now line 3. But basically, line 3 just nets together all of your passive activities. So it looks at all of your rentals, all of your syndications. if I buy a stake in a hair salon and I don't do anything, I'm not materially participating. It's passive. And it also gets netted out on line 3. So your rental losses can offset your hair salon income, right? If it's all passive, if it all retains that passive characteristic. So don't let CPAs tell you, one rental can't offset the other, or your syndication loss cannot offset the rental gain. It's not true. Have them prepare Form 8582. But for your purposes, you want to track that number every single year. So every single year, when you get your tax returns back, you go to Form 8582, you look at line 3, you get a spreadsheet, and you write it down every year, every single year. Especially important in years that you switch CPAs. Because, hey, it's the middle of tax season, right? Everybody makes mistakes. I think my firm's really good, but we still make mistakes. We may forget to carry forward your $400,000 of suspended passive losses. And so we report the new Form 8582 with 0. Well, $400,000 times 30% is $120,000 tax mistake that just was made, right? That's expensive. We have found 2 of those issues with clients where the CPA carried it forward or did not carry it forward. They switched CPAs a couple times. You start going back because you start asking questions like, these people have never sold their portfolios and they're not making a ton of money, but they're showing no suspended losses. You start going back and you realize, in 2013, when they switched CPAs, the new CPA didn't carry forward. And so then when they switched CPAs again in 2016, that CPA carried it forward, but they were carrying forward wrong information. So just literally hundreds of thousands of dollars just gone. It just gets wiped out. So you have to make sure that you have that number front of mind every single year. Form 8582, line 3, every single year, your suspended passive losses. Not only will you be able to catch any mistakes or anomalies, but you'll also be able to make better decisions throughout the year in terms of, hey, the market's hot. I want to sell a property. I know I have $250K of suspended passive losses, so I don't have to worry about 1031 exchange. Let's just go. I don't have to worry about all the admin headache and everything, all the effort that comes with it, right? Just simplifies your life. So that's selling your rental. That's one exception. The second exception is to earn less than $100,000, but own 10% of your rental activity and actively manage it. And that is a $25,000 passive loss allowance. We typically don't spend a lot of time talking about that. It does start to phase out, and it's totally phased out if you earn more than 150K. So just know that if you are below 150K, there's a much lower bar for these passive activity loss rules, meaning that if my rentals create losses, I can use those losses to offset my W-2 income, my business income, without having to jump through the hoops of exception number 3, which we'll go over here in a second. So there is something called the passive activity loss allowance. It's a $25,000 allowance that you can claim without having to jump through crazy hoops as long as you earn less than 100K. And it starts to phase out as you creep up above 100K. It's totally phased out when you reach 150. The third exception to the rule is the real estate professional status. So if I can qualify as a real estate professional, and if I can materially participate in the activity, then my losses are non-passive. And non-passive losses are great, right? So think about it as like 2 buckets of income. These rules, that's what these rules created, 2 buckets of income. The passive activity loss rules in 1986 said, we've got this passive bucket. All of your rental activities go into this passive bucket. And any trade or business that you don't materially participate in, like my hair salon investment that I was talking about, that goes into this passive bucket. In my non-passive bucket is my W-2 income, my business income, any activity that I materially participate in. Interest income, dividends, capital gain income from stock sales, crypto sales. That's all considered non-passive. Even though it doesn't sound non-passive, it's considered non-passive. So passive activities, rentals, any trade or business that I don't materially participate in. Non-passive, all my other real income. The problem, again, is that if I have passive losses, they get stuck in this bucket. And I want to be able to jump them into the non-passive bucket. Because if I can move them into the non-passive bucket, then I can offset my W-2 income today. Right? I can offset my business income today. And that's really important for time value of money perspectives, right? Because every time that you buy a rental property, you have predefined tax savings in that rental property, whether you realize it or not. Every time, if I buy a $100,000 rental property, I know that I'm going to be able to depreciate $85,000 of it over 27 and a half years. And that annual depreciation equals tax savings for me. I can accelerate that $85,000. I can take $30,000 of it today via a cost seg study and bonus depreciation. So I can accelerate those tax savings. But every time that you buy a rental property, you have predefined tax savings in that rental property. And I think everybody here would agree we don't want to leave cash in a bank account today because of inflation, right? If I leave my cash in a bank account, it's earning 0.5% if I'm lucky, but inflation's chipping away at it 9% a year. Cost of goods is going up. So the dollar that I have today cannot buy the same good next year because that the price of that good has gone up 9%. Well, the same thing's happening in your rental property. You have a bank of tax savings in your rental property, and you can choose to leave them there if you want to, but all you're doing is you're just leaving your money in a savings account that's giving you a 0.5% rate while inflation is going up at 9%. So you want to extract that, right? You want to do those cost seg studies. You want to get that depreciation as quickly as you can to get that tax benefit as quickly as you can. But anyway, so if I can do that, if I can get that depreciation, it's going to create a tax loss, but that tax loss is passive. So I have to be able to jump the loss into my non-passive bucket so that I can actually claim my tax loss today and offset my W-2 income and my business income. And like I said, the third way to do that is real estate professional status. And that's the big hot topic that everybody talks about. A real estate professional status, to qualify, you have to spend 750 hours in a real property trade or business. You also have to spend more time in real property trades or businesses than you do anywhere else. So if you have a full-time job, you cannot qualify as a real estate professional. If you're a mortgage broker, none of that time qualifies as a real estate professional. Yeah. So real estate professional is relatively narrow. There's 11 real property trades or businesses. Being a landlord is one of those real property trades or businesses. Being a real estate broker is a real property trader business. Flipping, developing, wholesaling, all that, real property trader business. Property management, real property trader business. So all of that time will count towards a real estate professional status. So if you can spend 750 hours and more time in real estate than you do anywhere else, you're going to be a real estate professional. And the next question is, do you materially participate in your rental activities? There are 7 tests for material participation. The 3 that we see most often, from easiest to hardest, is substantially all. That's test 1. That means that your time was substantially all of the time that anybody participated in the activity. So I could spend 50 hours self-managing my rental, do all the repairs myself. No other vendor touches it. I get no additional help. 50 out of 50 total hours. That's substantially all. Even though I only spent 50 hours of my time, I am materially participating in that rental property. If I spend 50 hours of time in this rental, but it's a short-term rental, and my cleaners spend 90 hours of time, now we're talking about 140 total hours, of which I only spent 50. That's not going to be substantially all, right? So then you jump to test number 2. Test number 2 is 100 hours and more than anyone else. So if my cleaner spent 90 hours and I spend 100 hours, then I've spent 100 hours and more than my cleaners and likely more than anyone else. But if my cleaner spent 103 hours, then I need to spend 104 hours managing this property, 100 hours and more than anyone else. The third test is 500 hours, and that's just a straight up safe harbor 500 hours. So if I can spend 500 hours managing my rentals, then I'm good. And that's going to be across, you have to make an election to group, but if you make that election to group all of your rentals, then it's 500 hours across all of my rentals. So if I have a rental portfolio of 10 properties and I'm like a real estate broker, so I qualify as a real estate professional, among my 10 properties, I'm self-managing, I'm spending a ton of time, I spend at least 500 hours. Not only am I a real estate professional, but I've also materially participated in my rental properties. All of my rentals are non-passive. Now, when I go do cost segs, now if I invest in syndications, all of that is going to be considered non-passive as well. And now I can wipe out my W-2 income. I can wipe out my spouse's W-2 income. If you're filing a joint tax return, only one person has to qualify as a real estate professional for you to get these benefits. Okay, so my spouse, I work full-time at my CPA firm. My spouse could go be a real estate professional, and then collectively we could go buy a bunch of rentals. We could bonus depreciate them via cost seg studies, use the tax losses to offset my CPA firm income.
All right, that was so much. I don't want to stop you, but let me ask you a question.
Sure.
And Moses, I'm going to get to you next. I'm a real estate professional, but I sold all of my properties that I owned and operated, and I'm a mortgage broker. How do I'm going to have to stop being the real estate professional this year because I sold all of those, right? Am I going
Well,
to be in a pickle because I now have to pick up some, I'm going to have some gains there.
so real estate professional status only helps you if you have losses from rental activities.
Which I
Otherwise,
did
it's not going
before.
to help you. Yeah, which you did before. Now, if you've liquidated all of your rentals, that's what you're
Yes.
asking. You've liquidated.
Yes.
Yeah.
Liquidated them, and now you're saying I'm no longer a real estate professional. I am doing what I do 100% of the time, which is brokerage,
Yeah.
a mortgage broker.
So if you liquidated all of your rentals, let's say that you liquidate all of your rentals in 2022 and you've got a ton of gain, then yeah, that gain is going to come due. You're going to have to pay tax on that. Unless you were to go and then acquire new rentals before the end of 2022, cost seg, bonus depreciate them, and the tax losses could offset the gain on sale of the rentals that you've liquidated.
But if I purchased or I sold those properties and put them into limited partnership syndication as a TIC, that now goes from owner operator to passive.
Yeah. So if you, are you 1031ing these? Did you 1031?
Yes.
Oh, well, if you've 1031, then there's no gain, right? So there's no current year gain that we have to figure out how to offset. What we now have is a portfolio of TIC interests. And yeah, I can't materially participate in a TIC interest. There's somebody running that TIC deal.
And I no longer have my real estate professional status.
Right. So I'm not a real estate professional. I can't materially participate. So all the TIC interest, that's just all going to be passive. So if it gives me income, it's passive income. If it produces losses, it's passive losses. And if I don't have any other passive income from any other rental activity, then those losses just get suspended on Form 8582 and they get carried forward. So you'll be looking at line 3 on Form 8582 and just tracking that on an ongoing basis, annual basis.
Fantastic. What else are you going to tell us about that? Because that was amazing.
Honestly, that was the abridged version. I could talk about section 469 for probably a good 4 hours. So all the ins and outs, and we could talk about hours that count and don't count, and the audits that I've helped with, and where people win and lose, and court cases, all sorts of fun stuff. But
well, okay, so let's talk about, because I know that this has come up. Everybody wants to be a general partner. Oh, and I've got 2 hand raises, so hang on. Let me just finish my sentence here, and then we'll come back to you. Everybody wants to be a general partner, and they want to put their money in as an LP, but they also want to take on general partner responsibilities and take advantage of the gains at the end. Correct? How does that work? How do you've got passive and you have non-passive in that application?
Well, if you are a general partner, then you have the ability to materially participate. If you are just a limited partner, you do not have that ability. So I could be a GP and an LP. I could invest on both sides,
Yes.
And that's fine. But typically on the GP side, you have to ask the question of who's actually running the deal. Okay. Because if I'm just raising capital, I raise $1 million for my friends and family and I go give it to Julie, and then Julie's the one that actually runs the deal, then I'm probably not materially participating, even though I'm a GP. So just because I'm a GP doesn't actually mean that I'm materially participating. I would need to be involved on an ongoing basis. I would need to have some sort of role aside from simply bringing capital to the deal and then walking away. That's my stance. So I actually think that a lot of GPs are probably not materially participating. Now, one of my partners at the firm, my co-host at the Tax Smart Investors podcast, we just rebranded the Real Estate CPA podcast to be the Tax Smart Investors podcast. And if you want like the 3-hour version of the Real Estate Professional Status, you should go check it out. It's on Apple Podcasts, Spotify, all the places. But we have a series, so we do like multiple episodes on real estate professional status and the passive activity loss rules. But anyway, my co-host Tom, also a partner at my firm, he will tell you, well, there's no tax court case that says that a GP can't be a real estate professional. So he kind of takes that approach. He'll say, well, there hasn't been a tax court case that says that I'm a GP and I can't be a real estate professional. So, and most likely the reason for that is because the IRS just doesn't want to front all the costs to try to figure out that structure of ownership and figure out who's actually participating or not. But yes, if you're a GP, you can potentially be producing hours that count as real estate professional status material participation hours. But if you're just raising capital and walking away, I would think that puts you in a riskier position. So you just got to be careful.
Awesome. Moses, what's your question? Wait a minute.
Yeah, thanks,
There
Julie.
you go. Yeah.
Brandon, thank you for doing the presentation. I've been at real estate professional status for over 20 years, and I haven't been audited once because I've always maintained material participation in all of my actual deals that I have around the country. I've always make sure I have more than the 100 hours superior to anyone else in there. So if you do it right, you're going to prevent your losses from being suspended. You can knock it off. Because I have a wife with W-2 income, I need to get rid of it because that's passive income that I can reinvest in real estate. But the question I have,
sorry to cut you off real quick, Moses. I didn't do my whole like pump up motivation sales pitch at the beginning here that I normally do on some of these presentations, but it's like, I mean, just think about the power of even saving $30,000 in taxes every single year. That's another house that I can buy, right? And that's just if I can do that for just 10 years, Moses has been doing it for 2 decades. I mean, like 30, I don't know how much you're saving, but $30,000 a year for 2 decades, just reinvesting that. That's incredible, right? That's somebody that's figured out how to beat the system. So anyway, sorry, Moses, go ahead.
It's all right. I'm in New York, so it's a lot more.
Yeah, okay.
The question I have, could you quickly touch, I know this was, but could you quickly touch how short-term rental are treated and sometimes it's not a real estate activity? I think that would be helpful for the group.
Yeah, yeah, absolutely. So those passive activity loss rules that I was talking about, built in 1986. There's only 3 exceptions to the rule. You have to sell a rental, you have to earn less than 150K, or qualify as a real estate professional. Well, there's actually a 4th exception to the rule, but it's more of like a loophole, not an official exception to the rule. So the way that it works, Section 469, the passive activity loss rules say all rental activities are passive unless you qualify as a real estate professional, and any trade or business that you don't materially participate in is passive. Now, whenever we're looking at the Internal Revenue Code, definitions are extremely important. Words are extremely important. So Section 469 says all rental activities are passive. So the question becomes, what is a rental activity? And it turns out they actually define what rental activities are not. And one of the are not definitions. One of the definitions of not a rental activity is any activity that you rent to customers with an average period of use of less than or equal to 7 days. So if I rent a property to customers, and on average, my average period of customer use is 7 days or less, then I do not have a rental activity under Section 469. And the significance is that Section 469 again says all rental activities are passive unless you qualify as a real estate professional. But if I don't have a rental activity, then I don't have to worry about qualifying as a real estate professional. And that's important because the second test to real estate professional status was spend more time in real estate than you do anywhere else. So I can't be a real estate professional running my CPA firm full time, right? But if I have a short-term rental, then it doesn't matter. I don't have to worry about real estate professional status. for my short-term rental. All I have to worry about is materially participating in my short-term rental activity. And remember those 3 tests for material participation. The first one was your participation is substantially all of the participation. I could self-manage my short-term rental activity, right?
Yep.
50 hours a year, not a lot of work. And now I'm materially participating in my short-term rental activity. And if I can materially participate in my short-term rental activity, then I have a non-passive activity. Remember those 2 buckets of income? I've now moved my short-term rental activity out of the passive bucket and into the non-passive bucket. And now I call markup and I do a cost segregation study on my short-term rental activity. And it generates, it's $1 million beach home, and it generates a $300,000 bonus depreciation. Or 300K is allocated to 5, 7, 15-year property, and I do 100% bonus on that. So now I've got a $270,000 tax loss that I claim against my CPA from income, all because I knew that the definition of a rental activity does not include a short-term rental, where the average period of customer use is less than or equal to 7 days. And because of that, I don't have to qualify as a real estate professional. And because of that, I don't have to worry about working full-time at a W-2 job or my business. I don't have to have a spouse that qualifies as a real estate professional. I just have to figure out, how do I materially participate in my short-term rental activity? Because if I can do that, then I can use my short-term rental losses to offset my income. I would say probably, so I think that this rule has been around forever, but I think that my firm like kind of brought it to light in 2020. And it's just like exploded. It's like this big thing. And now I'd say probably half of our clients own short-term rentals, and they're just reaping the tax benefits from it.
Unbelievable.
Yeah.
Thank you, Moses. But that means I have to manage it myself, though.
Oh, Julie, it is so easy. It's so easy to manage yourself. So I bought a beach home September of last year, right? Because I was like, yeah, let me put my money where my mouth is. So I bought a beach home September of last year, and I set up. I forget what it used to be, but it's hospitable now. So I've got hospitable. All my messages are pretty much automated. So all the guest check-ins relatively automated. I mean, I spend 5 minutes like setting up the smart locks each week, but I believe you can even automate that. I've got Price Labs that plugs into hospitable, and Price Labs is essentially like hotel sort of level pricing software. So it just automatically updates my listings price every single day based on supply and demand. And then I've got a cleaning crew, and I've got a linen crew. And so I just send my cleaning crew, my linen crew in every single week, and then they leave, and that's it. And I just manage like a few messages with the guests, but most of them are automated anyway. It's easy. Now I spent a lot of time at the beginning of this ownership, changing out fixtures, doing a lot of repairs, and a lot of this rehab myself. And that's where I got those material participation hours from. But once it's up and running, it can be relatively simple. And now that I own a beach home and this short-term rental thing, now I know when my clients are lying to me, right?
Crazy.
Yeah, they'll say, "Oh yeah, I spent 10 hours to list my property on VRBO," and 2 years ago to say, "Oh yeah, that makes sense," and now I'm like, "You're lying. There's no way."
Wow, crazy. All right, Vladimir, what do you got?
Hey,
There you go.
you hear me now?
Yep.
Thank you, Julie, and thank you, Brandon. Awesome material here. I'm just taking notes and soaking in everything. I have a question. So you talked about, on the example of the $10 million and the 30%, $3 million with the bonus depreciation, taking the NOI, you ended up on 270 or 2.7.
Yeah.
That's for the first year. When you go on the subsequent years, the second year, with your cost segregation studies, one, the LP is going to be able to offset those distributions during the year. And the second one, is there any other accumulation of depreciation that they're going to be doing through this cost segregation?
So,
and one more, so you can, then the GP. What's the role of the GP there? Because usually on these deals, the GP gets 20%, 20/80. How much the GP is taking advantage of all this accumulation depreciation.
Mhm.
So let me answer the last question first, because I think it's a really interesting question, and I'm going to answer it as an investor and also a business owner myself. As a business owner, I have 34 or so employees. We're adding 1 to 2 a month, and my job is to figure out how to incentivize each one of these people to reach maximum production for the firm without burning out, right? So that's the art. It's what's maximum production without burning out, and how do I incentivize that? The same thing happens whenever I invest in any sort of syndication. I want my GP to be incentivized to crush it from an internal rate of return perspective, an IRR perspective, right? So what I want to see when I personally invest, I want to see a waterfall structure for my GP that phases me out as we hit 15%, 20% plus IRR. I would prefer to give my GP 90% of the profit after we hit 20% IRR, because that means I'm walking away with 20%, right? That means I've crushed it. So they can have whatever they want after that. I don't care. I've like destroyed my investment projection, right? So that's what I want to see. I want to see a waterfall structure that gives me back money quickly. But as we hit hurdles, as we hit 15%, 20%, I want to start rewarding heavily my GP team so that they will be heavily incentivized to hit those hurdles, to reduce costs, to increase value, and hit those hurdles, and liquidate this property in 5 to 7 years so that I can get my capital back. I don't want to see a loss allocation to my GP if they're not putting in money. If they're going to put money in, that's fine. But if I'm the one fronting the capital, the reality is that the GP is supposed to be bringing their skills to the table. And so if they could walk away from this deal at any time, and now I have to go and operate the deal, which we've seen happen twice. I started my firm in 2016. We've seen it happen twice so far. So it does happen. The GP can just disappear. And then I've got to decide, do I start all these legal proceedings, or do I just try to take control of this property, operate it, and liquidate it? So I don't want the GP to get any amount of loss until I have maximized my loss potential. So me personally, I would want to see a loss allocation structure that says something like the following. First, we allocate 100% of our losses to our limited partners or to our Class A members until their capital account reaches $0. So that means that if I've raised $3 million and I have $3.1 million of tax loss, $3 million of that tax loss is going to go to my limited partners. The next $100,000 of tax loss, that's where at this point, I don't really care what happens as an investor. So I could go 50-50 on it. I could go 70-30 on it. It's less important to me. But what's important to me is that I get paid first. I get the allocation first because I'm the one that's fronting the capital. So you will see the 80-20, the 50-50. Sometimes we see based on economic interest, pro rata, just based on capital stakes. So the GP will end up with like a 30% loss allocation because they carve out 30% for themselves of the entire entity. And I'm not saying that's wrong by any means. There are people that go for it. Sometimes on smaller deals where you get like a couple whale investors that can bring millions to the table, they'll work with you on the terms specifically, and you'll see some different allocations going on. And that's fine too, whatever everybody comes to an agreement with. But I'm not going to go and invest, into a larger syndication that's paying the GP out, and I'm not going to invest in a larger syndication that's giving benefits to the GP that are not production oriented. So you're buying the property, you're getting an acquisition fee, you're probably getting an asset management fee as well. That's fine. But now I want to see production. I don't want to see the tax benefits on top of that until my capital accounts reach $0. That's my philosophy.
And and then now the subsequent years, the second year, third year, fourth year, is there any depreciation that can accumulate so the GP can provide more of that to the LP?
So,
and what is that and how that looks?
Yeah. So if you do, So sorry, I meant to answer that question. So if you do a cost segregation study up front, you're basically extracting the depreciation, like in the first year. So a cost, you have 3 options whenever you buy a property. Option number 1 is buy the property, don't do a cost seg study. And what I'll do is I'll depreciate the building value over 27 and a half years straight line. So if my building value is worth $2.7 million, I'll get $100,000 of depreciation expense every single year for 27 and a half years. The second option is to do a cost segregation study. And a cost segregation study is the practice of saying, okay, we've got $2.7 million of building value, $300K of land, total acquisition price was $3 million. But of this 2.7 million building value, there are components that are not going to last 27 and a half years. And we want to identify the value of those components, and we want to depreciate them over a faster timeline. So the cost seg study will say, well, we'll take that 2.7 million and we'll take some of it and allocate it to 5-year property, 7-year property, 15-year property, and then leave the rest in that 27 and a half year depreciation schedule bucket. And then that's it. And now you're depreciating value over 5 years, 7 years, and 15 years. But like think about $27,000 in this example. Let's say $27,000 was not allocated to 5-year property. That's $1,000 a year in bonus in depreciation, 27 and a half years, right? But if you allocate the $27,000 to 5-year property, now you're getting $5,200 of depreciation every single year for 5 years. So you're accelerating your depreciation through this cost seg study. So that's option number 2. Option number 3 is to do the cost seg study and also choose to 100% bonus depreciate the components that are less than 15 years. And that's the option that you should always take. Mm-hmm. Like there's no other, that is the option. If you are a believer of the time value of money theory, in that $1 today is worth less than $1 tomorrow, you always cost seg, you always take 100% bonus depreciation. So what that means is today I'm going to get a large write-off, but next year my depreciation is actually going to be lower than it would have been if I was just straight lining everything. So I'm actually going to start like especially as I start value adding this thing and flipping it and getting better renters in there, I'm actually going to start seeing cash flow that's going to come back to the LPs, mm-hmm. probably in year 3, 4, 5. That'll be taxable. It'll be taxable.
Perfect.
All right.
Thank you, Brandon.
Let's get on to our last one, which is Mr. Gross. What do you got? Last question.
Brandon, thank you very much. Awesome presentation. Where do you tell a client who can benefit from cost segregation and plans at least a 5-year hold, but is concerned about recapture tax?
So yeah, great question. So anytime they do cost seg study, your basis of your asset decreases, right? So let's say I buy $100,000 home, and I know you know this, Mark, but I'm going to explain this separately. So I buy $100,000 home, and I depreciate it $10,000. So my adjusted basis is now $90,000. Next year, I sell it for $100,000. I made zero money, right? A normal person is going to say, I made zero money. There's no gain to report. But a tax accountant says, well, you took $10,000 depreciation, so your adjusted basis is now $90,000. And assuming you didn't have any loss that's carrying forward, you've got basis of 90, you're selling it for 100, you've got 10K of gain, right? But the gain in this example is coming from depreciation. It's not coming from appreciation. I bought it for 100, sold it for 100. And because my gain is coming from depreciation, it's called depreciation recapture. And I recapture that at different rates than the same rates as my capital gain rates, but bonus depreciation is my ordinary rate. So it could potentially be higher rates. And I believe actually in the White House budget, there was a little line that said all recapture is recaptured at ordinary rates. So that'll be interesting to see how that goes through Congress here in the next couple months. Point is, though, is that if I take depreciation today and that creates a tax loss today, and I can claim that tax loss today, offset my other income, then when I sell this asset later, I will have a larger gain because I have this gain from depreciation, right? So if I've got, let's say that I could sell my 100K home for $105,000, still have the same $90,000 of adjusted basis. So I bought it for 100, depreciate 10, sell it later for 105. My gain is $15,000 now. So I sold it for 105. My adjusted basis was 90. $10,000 of that $15,000 gain is coming from depreciation recapture. $5,000 is coming from capital gain. So anytime that I depreciate assets and I sell it later at a gain, I'm going to have a larger gain thanks to this depreciation recapture. What do I tell clients? I educate them on the time value of money. So I simply just walk through. I use this example in a lot of my speaking events and on the podcast. Imagine today that you have $1 in your pocket, an actual dollar bill, which I don't know that I have actual cold hard cash in my home, but just imagine that you do. You get an actual dollar bill in your pocket. You go to the store, your wife's chirping at you. I need milk for the kids. Okay. So you take your dollar, you go back to the back of the store, and you see the half gallon of milk for $1. For whatever reason, you forget it or whatever, you just don't buy it. You put the dollar back into your pocket. You wash your jeans a few times throughout the next year. Now it's been 12 months later. Your wife's yelling at you again. You need to go get that milk, that half gallon of milk. So you go to the store. You're sitting there. You're looking at the milk. You reach into your pocket. You're like, oh wow, this dollar bill's still here. You pull the dollar out, but now you look at the milk and it's $1.03, and your dollar can no longer buy that half gallon of milk. Because of inflation, the cost of goods goes up over time, right? So last year, 12 months ago, my cold hard dollar bill could have bought that half gallon of milk, but I forgot about it, put the dollar bill in my pocket, washed my jeans a couple of times, went back to the store, and now my dollar cannot buy that half gallon of milk because now it's $1.03. So what I tell clients is kind of that whole thing of you have tax savings, predefined tax savings that are already baked into each property that you acquire. And if you choose not to extract that value, then you are saying, I don't care about inflation eating away at my available cash. That's what you're saying. And the vast majority of people that I have that conversation with then go, well, I'm never going to do that then. I will always do a cost seg study and bonus depreciate. Now, what I also caveat that with is I will say, don't go buy a Ferrari. Okay. So whatever tax savings I'm getting from this bonus depreciation, I need to roll back into more assets. I need to grow that tax savings. Because if I go buy a Ferrari or a boat or whatever, something that legitimately depreciates in value, then when I do sell this asset and it comes due, I actually won't have the cash to pay the tax. So make sure that you do take the tax savings and go reinvest it. But as long as you do that, the depreciation recapture will always be emotionally painful, but it will not be rationally painful.
Amazing. Yeah. Now I have to hear, how do we get a hold of you? How do we listen to you? I'm mesmerized by everything you're saying. I could do this every day of the week. Gary Rice, what do you think about Brandon? Gary and I were talking about he's looking for a new CPA. What do you think, Gary?
Oh yeah, this is exactly what I need right now. He's speaking right to me.
Exactly.
Yeah.
I mean, this is amazing. Brandon, how do we get a hold of you? What if we want to do business with you and use your firm? How do we do that?
Yep. Excuse me. So if you are interested in exploring a client relationship, you can check us out at therealestatecpa.com. We have a lot of resources. We have a blog. We have our podcast on our website as well. So you can check out all of those resources. If you want to get into our ecosystem, so if you're happy with your CPA right now, that's totally cool. We can still, be friends. Join our Facebook group. We have about almost 10,000 people in it now, but it's called the Tax Smart Real Estate Investor Facebook group. So if you go to facebook.com, here, I'll link it up, facebook.com/groups/tax smart investors. That should get you pretty close, or take you right to it. Go join that group. We have these conversations like passive losses, real estate professional status, short-term rentals, literally every day. And me and my partner and a couple other people at my firm will triage questions and stuff like that. So that's a really great way to get some interaction with us. And then I would highly recommend, typically people that are on Zoom sessions like this enjoy podcasts. So I would go check out our podcast. It's the Tax Smart Real Estate Investor podcast. It's on Apple, iTunes, Spotify, like Amazon now has stuff. And it's like everywhere. So go listen to that because we do a really good job. This was like the very fast we covered a lot.
Yeah.
But on the podcast, what we do is we'll take one topic and we'll very slowly step into it, and you will literally walk away from that podcast being smarter than your CPA. It's a promise that we that we make to everybody that listens to that and joins our Facebook group. The whole point of what we're trying to do is like we realize we are expensive. We realize you already have CPA relationships, and that's totally cool. But the reality is that a lot of CPAs don't understand Section 469. And it costs people so much money. It's insane. So I launched this Facebook group. We doubled down on the podcast to basically say, look, you don't have to work with us, but at least just listen to what we're saying, because we're going to give you citations, and you can go to your tax returns and start finding the errors and have better conversations with your CPA.
Oh, that's so fantastic. I've been in this business for 30 years, and I have never found a better understanding of what you just took us through. I want to appreciate you sharing that with us. The podcast name is Tax Smart Real Estate Investor Podcast, correct?
Yeah. I'm still
Okay.
I'm still struggling to
No, we
say
got
'cause
it.
I'm
We
so
got
used
it. Jeff did it. So thank you for
we
very
just
much.
rebranded like 3-4 weeks ago. So I'm still like, it's not rolling off the tongue yet.
Well, you are such a great resource, and I can't thank you enough for joining us tonight. Our
Thank you.
listeners are devoted, and a lot of them take what they hear today and they apply it, and certainly reach out to the folks that have spent time with us. So I really want to thank you, for Brandon, for joining us. And Moses, thank you for encouraging me to track him down, because you're a real treat to have. So